Welcome to today's video. First, we will dismantle the 1% checking account gimmick and show why your functional cash deserves better. Next, we'll compare real numbers, unpack hidden hassles, and map out a simple plan to optimize your cash management. Finally, we'll include quick quizzes and diagrams to lock in the concepts, and we'll end with an actionable checklist and recap. Here's our agenda. First, we'll explain why 1% is not good enough. Then, we'll run the numbers to reveal the opportunity cost. After that, we'll cover the hidden hassles of promotional checking. Next, we'll highlight better alternatives like high-yield savings and modern cash management accounts. Then, we'll walk through a step-by-step action plan, test your knowledge with short quizzes, and reinforce everything with diagrams. Let's start with why 1% is not good enough. While 1% technically beats zero, the absolute dollar gain on functional checking balances is negligible. More importantly, the opportunity cost compared with modern high-yield savings or cash management accounts is substantial. In other words, what you do not earn is the bigger hidden cost. Before we proceed, a quick disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Interest rates and account terms can change frequently. You should validate account features, coverage, and APYs directly with providers, and consider your personal circumstances before making any financial decisions. Now let's ground this discussion with numbers. If you keep $4,000 in checking at 1% annual percentage yield, you earn about $40 per year. After accounting for taxes, many savers would keep around $30 to $35. That roughly covers a single streaming subscription. In contrast, at 4%, that same $4,000 generates about $160 per year. That is more than 4 times the 1% result. If we scale the balance to $10,000, 1% yields $100 annually, while 4.5% yields $450, a $350 difference. Inflation and opportunity cost amplify this gap. The practical objective is to reduce cash drag on essential balances while preserving easy access to funds. This flowchart begins at paycheck received. The first decision asks whether you have an immediate bills buffer, typically 1 to 1.5 months of expenses, in checking. If not, you continue building that buffer. If yes, the next decision checks whether your checking balance exceeds that target buffer. If it does, you move the excess to a high-yield savings or cash management account, ideally above 4%, and set automatic transfers to occur the day after payday. If the balance does not exceed the buffer, there is no transfer, and you continue paying bills from checking. Periodically, you review interest rates and account terms each quarter. A note reminds you to maintain instant liquidity and ensure appropriate deposit or securities coverage, such as FDIC, NCUA, or SIPC, depending on the account. Let's acknowledge the fine print behind many promotional checking offers. They often require a minimum number of debit card transactions per month to maintain the rate. There may be direct deposit or minimum balance requirements that add friction. Some offers apply only in certain regions or cap the balance eligible for the promotional rate. Because rates are variable and requirements are strict, you might unintentionally miss the top tier. If you prefer using credit cards for rewards, forced debit usage can cost you points or cash back, creating an additional hidden expense. Here is a side-by-side comparison. On the left, promotional 1% checking sounds better than zero but produces small absolute returns. It often requires debit transaction minimums, direct deposit hoops, or balance caps, and it pays on a checking balance that ideally should remain lean. There is also the risk of missing requirements and dropping to a low base rate. On the right, high-yield savings or cash management accounts commonly pay 4% or more with fewer hoops, provide fast transfers at many providers, and serve as a better home for funds above your bill-paying buffer. This approach reduces cash drag while preserving credit card reward strategies. This table highlights the opportunity cost across common balances. At $2,000, 1% produces $20 annually versus $90 at 4.5%, a $70 difference, or roughly $5.83 per month. At $4,000, the gap is $140 annually, or about $11.67 per month. At $10,000, the difference is $350 per year. At $20,000, the difference grows to $700 annually. These numbers illustrate why keeping too much in checking can be surprisingly costly over time. This pie chart proposes a sample allocation, about 20% for a checking buffer representing 1 to 1.5 months of expenses. The majority, around 60%, sits in a high-yield savings or cash management account earmarked for 3 to 6 months of emergency funds. The remaining 20% can be allocated toward investments or other goals, depending on your situation. Of course, these allocations are examples and should be tailored to your risk tolerance, access needs, and financial plan. Here is a practical 7-step plan. First, calculate your monthly expenses to determine a realistic buffer. Second, maintain 1 to 1.5 months of expenses in checking for predictable bills and immediate access. Third, open a top-tier high-yield savings or cash management account, ensuring appropriate FDIC, NCUA, or SIPC coverage as applicable. Fourth, link your checking and savings accounts and enable instant or same-day transfers if available. Fifth, automate transfers so that the day after payday, any balance above your target buffer moves to the higher-yielding account. Sixth, review rates and terms quarterly, and be willing to switch if a materially better option appears. Seventh, avoid debit swipe requirements that undermine your credit card reward strategy. Here is a compact Markdown-style cheat sheet. It lists essential formulas, such as annual interest equaling principal times the annual percentage yield, net interest after tax equaling interest times 1 minus the tax rate, and the rule of 72, which approximates years to double as 72 divided by the annual percentage yield. The example compares $4,000 at 1% to 4%. A pro tip reminds you to reassess your buffer after major life changes or large expenses. Quiz time. The question is, if you keep $4,000 in checking at 1% APY for a full year, approximately how much interest do you earn before taxes? Your options are $4, $40, $400, or $4,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $40. 4,000 multiplied by 1% equals 40. While the calculation is simple, the takeaway is significant. The absolute gain on functional checking balances is small, and opportunity cost is the real issue. Here's your second quiz question. Which is a common requirement of so-called high-yield checking accounts that can reduce their real-world appeal? The options are making 12 or more debit card transactions monthly, no minimums or activity requirements ever, a guaranteed fixed rate for 5 years, or unlimited balance earns the promotional rate. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is making 12 or more debit card transactions monthly. Many promotional checking accounts require frequent debit usage to maintain the top rate, which adds friction and may conflict with using credit cards for rewards. This timeline shows the monthly cadence. On payday, funds arrive. Your bill's buffer remains in checking. The day after, any amount above your buffer automatically moves to the high-yield account. The emergency fund grows at a higher rate. When large planned expenses arise, you may transfer funds back to checking. Each quarter, you review rates and rebalance if needed. This mind map centers on your cash ecosystem. One branch is checking for the bill's buffer with direct debits, bill pay, and fraud alerts. Another branch is the high-yield savings or cash management account for the emergency fund and short-term goals, ideally earning 4% or more. A third branch covers investments, including brokerage and retirement accounts, with risk-based allocations. Additional branches represent automation through automatic transfers, periodic rate reviews, and alerts, and coverage considerations such as FDIC, NCUA, and SIPC limits. Here are the key takeaways. 1% on checking is technically better than 0, but trivial in absolute dollars. The primary loss is opportunity cost. High-yield savings or cash management accounts can pay 4% or more with relatively easy access. Avoid debit swipe hoops that undermine your credit card rewards. Keep a lean checking buffer and route the remainder to higher yield. Review rates and terms quarterly and be willing to switch. In summary, we dissected the 1% checking gimmick and quantified the opportunity cost. We highlighted the hassles attached to promotional checking requirements. We mapped a more efficient structure using high-yield savings or cash management accounts for excess cash. You now have a practical 7-step plan along with visual guides to implement it. Thanks for watching. If this helped you reclaim lost yield, please like the video, share it with a friend who keeps too much in checking, and subscribe for more practical money frameworks. In the comments, tell us your current APY and what you plan to change this month. Until next time, keep your cash efficient and your goals funded.